In the 1980s, American finance entered a period of rapid change. Traditional corporate funding had long depended on bank loans and investment grade bonds issued by well established companies. But a different segment of the bond market, high yield debt, often called junk bonds by critics, expanded dramatically. This shift mattered because it widened access to capital for companies that were growing quickly, restructuring, or operating outside the safest credit categories. It also created a powerful new engine for mergers, acquisitions, and corporate takeovers. Michael Milken became the most recognizable figure in this world. Working at Drexel Burnham Lambert, he helped build a large and influential market for high yield bonds. Supporters argued that Milken's work democratized capital by giving non traditional issuers a way to raise money and compete. They pointed to companies that used high yield financing to expand, create jobs, and challenge incumbents. Critics argued that the system encouraged excessive leverage, rewarded short term deal activity, and concentrated too much influence in a small network of deal makers and traders. To understand why the junk bond era became so controversial, it helps to focus on incentives. High yield bonds pay higher interest because investors accept higher risk. If a company succeeds, investors earn attractive returns. If it struggles, the downside can be painful. That basic trade off is not inherently unethical, it is simply risk pricing. The controversy arises when market power, information flows, and conflicts of interest become tangled, especially when a single firm becomes central to financing, trading, and distributing bonds for many deals at once. Drexel's high yield desk was not just a passive participant, it often acted as a catalyst. In many transactions, the availability of junk bond financing turned maybe deals into possible deals. When financing becomes abundant, the pace of takeovers can accelerate, and corporate leaders may feel pressure to respond quickly. This can reshape business strategy. Companies may prioritize defensive measures, asset sales, or aggressive restructuring to keep up. Milken's influence also reflected how financial markets reward networks. Issuers wanted capital, investors wanted yield, deal makers wanted funding certainty. When one intermediary seems able to connect all three efficiently, the intermediary's power grows. That power can bring innovation, but it can also create a fragile ecosystem where too many outcomes depend on one pipeline remaining open. In an educational documentary lens, the early Milken story is about a paradox, a financial tool that can be used responsibly to fund growth can also amplify risk when used at large scale in competitive deal environments. High yield debt can be a bridge for companies that are improving but not yet investment grade. At the same time, if firms take on more debt than their cash flow can support, vulnerability increases. Small setbacks can become large problems, and when many deals are financed with similar structures, stress can spread across the system. This era also raised questions about market fairness and transparency. When financing is complex and relationships are tight, it becomes harder for outsiders to understand who benefits, who bears risk, and whether pricing reflects real fundamentals or the momentum of a deal boom. The more rapidly deals happen, the more likely it is that due diligence becomes compressed and that optimism becomes a substitute for careful evaluation. Milken's rise, therefore, sits at the intersection of innovation and strain. His work helped shape a new capital market, but it also intensified debate about whether finance was serving the broader economy or mainly feeding an accelerating cycle of takeovers and leverage. That debate set the stage for deeper scrutiny not just of a product called junk bonds, but of the conduct, governance, and ethical boundaries inside the networks that powered the 1980s deal machine. High yield bonds are not mysterious instruments. They are debt securities issued by companies whose credit ratings are below investment grade or whose risk profiles are considered higher for other reasons. Investors receive interest payments and principal repayment, and in exchange, they accept a higher probability that the issuer may face financial stress. In a balanced market, pricing reflects careful analysis of the issuer's business model, cash flows, competitive position, and management quality. During the 1980s, however, high yield bonds became deeply linked to takeover financing. Many acquisition structures relied on significant borrowing, and high yield debt could provide large amounts of capital quickly. This mattered because speed and certainty are powerful advantages in competitive bidding situations. If a bidder can signal that financing is available, it can act faster than rivals and close deals sooner. This environment created ethical pressure in at least three ways. First, conflicts of interest could emerge when an institution was both distributing bonds to investors and supporting the deal ecosystem that generated those bonds. When success is measured by deal volume, there can be subtle incentives to keep the machine moving, even when caution would be healthier. The risk is not that high yield bonds exist, but that the business model becomes dependent on constant expansion and continuous deal flow. Second, market influence can become outsized when a single player dominates pricing and distribution. In a healthy market, multiple intermediaries compete, and pricing reflects diverse viewpoints. In a concentrated market, pricing can become less transparent. Issuers may feel they must participate on the terms offered. Investors may believe they are seeing the best opportunities, even if the selection is shaped by a small circle's priorities. Third, information asymmetry can increase. High yield deals often involve detailed knowledge of a company's financial condition, strategy, and risk factors. Investors rely on disclosure and on intermediaries to present terms fairly. If disclosures are incomplete, overly optimistic, or designed to minimize perceived risk, investors may not be making fully informed decisions. The Milken related controversy was not a simple debate about whether junk bonds were good or bad. It was a debate about whether the surrounding ecosystem encouraged behavior that blurred ethical lines, especially around market practices, relationships with clients, and how deals were structured and marketed. When a market is booming, it is easy for participants to confuse rising prices with true stability. That confusion can lead to complacency, and complacency can lead to shortcuts. From a learning perspective, This is where modern compliance concepts become useful. Regulators expect firms to manage conflicts, ensure truthful disclosure, avoid improper incentives, and maintain robust controls over trading and distribution. When a financial product becomes central to many transactions, the need for governance increases, not decreases. Another important educational point is that innovative finance often creates new gray zones before rules fully catch up. The 1980s high-yield boom expanded faster than the cultural and procedural systems needed to manage it. That mismatch, rapid innovation paired with slower governance, can produce misconduct risks even when many individuals believe they are simply competing. This period also illustrates a key principle. Reputation can become a form of leverage. If a market believes that one desk or one firm is essential, that belief shapes behavior across the system. People defer, imitate, or rationalize. They may stop asking hard questions because the network appears successful. In hindsight, that is often the moment when ethical risk quietly rises. By the middle of the decade, the high-yield market was huge, highly influential, and tightly interconnected. The same features that made it powerful, speed, scale, relationships, also made it vulnerable to scrutiny. And when scrutiny arrives, authorities typically focus less on the popularity of the product and more on conduct, whether rules were followed, whether markets were treated fairly, and whether the pursuit of profit crossed boundaries that exist to protect trust. When regulators investigate financial misconduct, they typically follow evidence trails that markets naturally produce: transaction records, timing patterns, communications, and relationships among participants. The aim is not to punish risk-taking. Markets require risk-taking. The aim is to ensure that the rules of fairness, truthful disclosure, honest dealing, and appropriate separation of roles are respected. As the 1980s progressed, Drexel Burnham Lambert and individuals connected to its high-yield operations faced growing legal scrutiny. In educational terms, it's useful to understand why a boom era can attract enforcement attention. A booming market tends to generate three conditions: intense incentives, compressed timelines, and normalization of aggressive behavior. Those conditions can lead some participants to push beyond what regulators consider acceptable. Michael Milken's legal troubles became one of the most prominent outcomes of this period. Without using sensational language, the core theme is that authorities alleged improper conduct in how certain transactions were handled and reported, including issues tied to securities regulations. The case became highly visible, and it signals that regulators were prepared to challenge powerful financial networks, not just individual small actors. A key educational lesson here is how compliance failures become strategic risks. In business, strategy is often described as products, markets, and competition, but compliance is also strategy because legal outcomes can reshape a firm's ability to operate. When an institution becomes central to financing activity, Its resilience depends not only on market demand, but on the strength of its controls and ethical boundaries. The costs of legal exposure go beyond fines or formal penalties. They can include loss of trust among investors and clients, reduced access to capital as counterparties become cautious, talent disruption as employees leave or are reassigned, business model fragility if core activities face restrictions, long-term reputational damage that influences future opportunities. These effects matter because they demonstrate how misconduct risk can destabilize systems, not only individuals. Another important concept is that enforcement often focuses on patterns and processes. Regulators ask, were disclosures complete? Were transactions structured in ways that obscured reality? Were reporting obligations met? Were conflicts managed? Did people follow internal policies designed to prevent improper behavior? These questions are about integrity, not about whether profits were impressive. The Milken episode also illustrates how public narratives can oversimplify complex cases. Some observers saw Milken as a visionary who expanded capital access. Others saw him as emblematic of a culture that prioritized deal volume and influence over restraint. In educational storytelling, it is better to hold both realities as part of the lesson. Innovation can be real, and ethical failures can be real at the same time. Importantly, the high-yield market's growth did not occur in isolation. It was connected to broader corporate behavior, takeovers, restructurings, and aggressive financial engineering. When the cycle is expanding, weaknesses are harder to see because refinancing is easy and optimism is widespread. But when the cycle tightens, vulnerabilities become visible. A system heavily reliant on confidence can change quickly when confidence declines. The Milken case became a landmark not merely because of one individual, but because it changed how many people thought about Wall Street's boundaries. It reminded the industry that influence does not replace accountability. It encouraged firms to professionalize compliance, strengthen documentation, and treat ethical risk as a central operational concern. From a viewer's perspective, the lesson is not to fear finance, but to understand it. Financial systems can fund growth and innovation, but they require credible rules. When those rules are treated as negotiable, the entire ecosystem pays a price, first in trust, then in stability, and finally in opportunity. One of the most instructive outcomes of the 1980s high-yield era was the downfall of Drexel Burnham Lambert. Drexel's identity had become closely tied to the high-yield bond market and to the network of issuers and deal makers who depended on that financing. When legal and reputational pressures intensified, the firm's position weakened and its business model, built around confidence and market access, proved vulnerable. This is a critical educational point. Financial institutions are not only balance sheets, they are trust machines. A bank or broker-dealer depends on counterparties willing to trade, clients willing to engage, and investors willing to buy. When trust erodes, liquidity can shrink quickly. And when liquidity shrinks, even a strong franchise can struggle. Drexel's collapse showed how concentration risk works in real life. When a firm dominates a market segment, it may enjoy profits and influence during expansion, but it also becomes a single point of failure. If the firm faces restrictions, scrutiny, or reputational decline, the entire segment can contract suddenly. That is exactly what happened in the high-yield world. The market did not disappear, but it had to reorganize, repricing risk and rebuilding distribution channels. For the broader economy, this shift mattered because many companies had come to rely on high-yield financing. Some used it responsibly to expand or restructure. Others took on heavy debt loads that were sustainable only under favorable conditions. When market conditions tightened, the margin for error shrank. Companies with high leverage faced difficult choices: asset sales, cost reductions, refinancing under tougher terms, or strategic changes to stabilize cash flow. In documentary analysis, it is important to avoid simple moral labels like good or bad. Instead, focus on mechanisms. The mechanism is that leverage amplifies outcomes. It can amplify growth if conditions cooperate, but it can also amplify distress if conditions change. When an entire deal ecosystem leans heavily on leverage, the system becomes more sensitive to interest rates, investor sentiment, and regulatory attention. Drexel's collapse also illustrates how legal pressure can become a business pressure. Even before a final outcome, investigations can disrupt operations. Clients may hesitate to associate with the firm. Investors may demand higher yields to compensate for perceived risk. The firm may face tighter funding conditions. The result is a feedback loop. Weaker confidence leads to weaker market position, which leads to even weaker confidence. For compliance culture, Drexel's collapse became a cautionary tale. It suggested that ethical lapses are not merely public relations problems, they can be existential threats. This realization pushed many institutions to treat compliance as a core risk function, similar to credit risk or market risk. The goal became prevention through structure, policies, surveillance, documentation, and leadership accountability. Another subtle lesson concerns organizational dependency on star performers. When a firm's identity becomes tied to a small number of highly influential individuals or teams, governance can become harder. People may hesitate to challenge them. Controls may be applied unevenly. When performance is exceptional, it can create an aura that discourages oversight. Drexel's story reminds modern organizations that consistent rules and independent risk management are essential precisely when business is booming. In the long run, the high-yield bond market survived and matured, but Drexel's collapse marked the end of a particular era, a period when speed, deal volume, and concentrated influence defined the culture. The industry's next phase involved more distributed participation, more formal compliance expectations, and a clearer understanding that innovation must be matched by governance. After the turbulence of the late 1980s, High-yield bonds did not vanish. Instead, they evolved. This is a powerful educational lesson. Markets rarely abandon useful tools entirely. They adapt, redesign, and regulate. High-yield debt remains part of modern finance, funding leveraged buyouts, growth companies, and restructurings. The difference is that the market today is shaped by the lessons learned from earlier cycles, especially the need for transparency, diversified intermediaries, and stronger controls. Michael Milken's legacy is therefore complex. Many credit market professionals acknowledge that high-yield bonds broaden the range of companies that could access capital. That can be beneficial. Growing businesses may not fit traditional investment-grade profiles, yet they can still be viable and productive. High-yield markets can support job creation, competition, and innovation. At the same time, the 1980s experience demonstrated that a fast-growing market can become unstable when governance lags behind growth. When deals are abundant and investors chase yield, pricing can become optimistic. Underwriting standards can loosen. Risk models can become overconfident. And if influential players become too central, the market can become vulnerable to a single shock, legal, reputational, or financial. A crucial analytical point is that high yield is not a moral category, it is a risk category. The ethical and stability questions arise from behavior, how the product is sold, how risks are described, how conflicts are managed, and whether participants respect rules designed to protect fairness. When those conditions are met, high-yield markets can serve a legitimate function. When they are not, the market can amplify fragility. For viewers, the practical learning can be organized into 3 themes. Risk should be priced honestly. Higher returns exist for a reason. Investors should receive clear, complete information about risks, not just optimistic narratives. Leverage requires humility. Debt can accelerate growth, but it reduces flexibility. When conditions change, heavily leveraged structures can become strained quickly. Governance must scale with innovation. When a market grows rapidly, compliance, oversight, and transparency must grow alongside it. Otherwise, small failures become big ones. The Milken era also influenced how modern finance talks about ethics. Many institutions now emphasize that winning includes how results are achieved. This cultural shift is not perfect, but it reflects an industry learning that reputational and legal risk are business risks. If an organization treats compliance as an obstacle, it may pay a larger price later. Another important legacy is the professionalization of credit analysis. Over time, investors and rating agencies developed more refined frameworks for assessing high-yield issuers. Covenant structures, disclosure standards, and market conventions evolved. These developments were shaped by experience, by seeing what happens when leverage is too high, when documentation is weak, or when optimism replaces discipline. In educational storytelling, the goal is not to moralize, but to clarify cause and effect. The high-yield boom created opportunities, but it also created incentives that stressed ethical boundaries. When boundaries broke, consequences followed for individuals, institutions, and markets. That arc is valuable because it is repeatable in many domains. Rapid growth plus weak governance often leads to instability. Looking back at Michael Milken and the 1980s high yield era, the most useful question is not who was right, but what can we learn that applies today? Modern markets still face the same underlying tension. Competition rewards speed and creativity, while stability requires restraint and transparency. The difference now is that we have clearer frameworks for managing that tension if organizations choose to apply them seriously. A modern educational takeaway is the importance of conflict management. In finance, conflicts are common because institutions often play multiple roles: advisor, underwriter, distributor, and trader. Conflicts do not automatically mean wrongdoing, but they require controls, disclosures, and independent oversight so that clients and investors can trust the process. Another takeaway is culture design. Culture is not a slogan, it is what people do under pressure. Organizations reduce misconduct risk when they reward long-term outcomes, not just short-term volume. They encourage questions and skepticism, even when business is booming. They protect employees who raise concerns in good faith. They separate revenue goals from compliance decisions. They train leaders to model ethical boundaries consistently. This matters because high-pressure environments can normalize aggressive behavior. People may begin to treat "everyone does it" as a justification. The Milken era shows why that mindset is dangerous. When market conditions or scrutiny changes, the cost of normalized boundary pushing can be severe. A third takeaway is system resilience. Markets are healthier when they are not dependent on one dominant intermediary. Diversity of participants improves pricing, transparency, and stability. When one pipeline controls too much distribution, a disruption can affect the entire ecosystem. Modern regulation and market structure aim, imperfectly but deliberately, to reduce that concentration risk. From an investor education angle, the story encourages discipline. High yield can be appropriate for certain portfolios, but it requires thoughtful risk assessment. Investors should evaluate issuer fundamentals, cash flow durability, and the broader cycle. They should be cautious about narratives that imply risk has been solved simply because markets are rising. From a professional ethics angle, the story reinforces a simple rule: integrity is a competitive advantage over time. It lowers legal risk, preserves reputation, and builds durable relationships. In finance, relationships are long-term assets. When trust breaks, rebuilding it is difficult and slow. Finally, this era teaches that innovation must be paired with accountability. High-yield bonds proved that new capital tools can open doors, but the same tools can create instability if incentives overpower governance. The best version of finance is one where creativity serves real economic goals: growth, productivity, and opportunity, while rules protect fairness and transparency. The Milken chapter remains one of the most studied financial stories of the modern era because it sits at the intersection of ambition and boundary setting. It challenges viewers to think beyond headlines and to understand how systems behave under pressure. And it leaves a clear educational message. When markets grow fast, the most important work is not only making deals, it is building structures that keep the market honest, resilient, and worthy of public trust.